tunic, he emerged from the steam-filled chambers into an evening almost as humid. Clouds gathered in the northern sky. More rain coming. Not an airship in sight. Now that the marauders were dead.
Hi, Manon. I think you're on mute.
Hi, can you hear me now?
I can hear you now.
Oh, the background even moves.
Yes, it is quite incredible, those northern lights you have.
How are you doing?
Oh, okay. How are you?
Okay. Almost started hyperventilating when all those contracts came in today.
Yeah, I honestly didn't even really look at it because I was trying to make sure I was ready for this.
Good. I didn't want you to. I wasn't even going to tell you until tomorrow.
These are ones that have to process next week. Is that right?
Yes. Yeah, they have to process on the 15th or by the 15th. Hey, Becky. Oh, she might still be connecting to audio.
Hello.
Hey, Becky.
Hello.
I didn't want everybody to see my unmade bed and my messy room, so I gave myself a different background.
You can only see the walls of my room, so I think I'm okay.
Mm-hmm.
I just sit in the dark, so you can't see anything behind me.
I'm gonna go get some cookies. I'll be right back.
Okay.
Brain food.
Mm. The app is working better, the new one.
For iSolved?
Yeah, that's not an app, but still.
Right. No, I agree. It's been working pretty good.
Do you hear something weird? Is that just me?
I do not hear something weird. Must be you.
Okay. Just kind of squeak.
My husband is going to come home at some point and my dog is going to bark, just so you're aware. And unfortunately, my office has no door, so it's an open concept.
Open concept. I like that.
Is it the only thing that's upstairs?
No, we have a spare bedroom as well. So the stairs, there's a half wall in front of me and the stairs are on the other side of that. So they come up in the middle and then you can go either way at the top of the stairs. And this side just has a half wall with no door or anything. And the other side is a full bedroom.
Okay. My screen is making funny noises. It's not annoying at all. All right, we're still 5 minutes early. How are you doing, Becky? How's things in your world? Have they slowed down at all?
Well, it's quarter end, it's year end for both payroll and HR. So I have all my payroll stuff to do, and then I've got all HR stuff, year end stuff to do as well. So yeah, no, not slowed down at all.
Yeah, no. I'm really, go ahead.
We can relate. That's all I was gonna say.
I'm like really out for January 20th. That's like, if things don't get better,
I was like,
after that day, I don't know what I'm gonna do.
yeah, I just kept thinking, okay, so our new system made quarter end really, really easy for me. Oh, welcome to my backyard, everyone.
Aw. It's beautiful.
That's my garden.
I was thinking it was some,
Yeah, my own personal garden. That's my
That's
garden.
impressive.
that is, I was thinking it was like mine, like one of the backgrounds.
But anyway, the quarter end was okay, but year end, I have to do all these reconciling between the old system and the new system, which is taking a really long time. But thank goodness I already have quarter end done. So, but then I get this from our 401k provider. Oh, here, I need you to do a census of everybody that's worked for you for this year, and I need this information and this information. So I'm like, oh my God, as if I didn't have enough to do. And then the girl who works in the office doing, just little stuff. Well, she graduated with her degree, so now we're sending her off out into the field. If she's not in the office anymore, so guess who could take over office stuff?
Dang it.
Yeah. It's like, we really need this economy to get going because I need to hire some help.
Yeah.
Right.
And we just hired help, but it takes a little while for them to get up to speed on things. So
True.
Yes, it does.
oh, I just remembered I need to send all of you RCH credits for being at class. Okay, did everybody get the pre-test and the glossary and the PowerPoint?
I just got the pre-test.
Okay, then I need to send out those other two. Would it be helpful to have the PowerPoint and the glossary before each class?
I think so. No.
Yeah.
Okay.
Yes, please.
Who's the main teacher tonight, Manon?
Melissa.
Oh, wonderful, Melissa. Isn't that
Oh,
nice?
well, we'll do our best. It's been a crazy few weeks.
Oh, no. Don't sell yourself short, Melissa. You're
Thanks.
All right, do you want to share your screen? Do you know how to do that, Melissa?
Oh, in theory. That look about right?
Yes.
Perfect.
Oh, there's Angela.
Hi, Mannon.
Hello.
You're so darn cute. Are you the only one here?
No, everybody. Well, 1, 2, 3, 4, 5, 6. Who are we missing? Rebecca's not coming.
So is everybody in the waiting room or are we just hanging out chatting?
No, everybody was just chatting.
Oh, cool.
Yeah.
Hi, everybody.
Hi, Angela.
Hi, Angela.
Hi, Melissa.
Hello, hello.
So guess what? I stopped at Safeway on the way home
Mhm.
and they gave me the senior discount.
Take it.
There was mixed emotions there.
That's terrible.
I took advantage of that early in the pandemic when they had the senior hour. I made my
Yeah.
husband go because he actually looks senior, but he really was senior. But he really looks it because he's got the white hair and the white beard. So I'm like, I really, really need to get this. Will you just go in the senior hour, please, when there's still some left?
Right. Yeah, it's a mixed blessing. And then on top of that, she was having trouble ringing my telephone number in to give me my Safeway discount. And my groceries were $70. I'm like, it's just for dinner tonight. So I looked at the receipt and she didn't cash out the guy in front of me. So I got his groceries and my groceries, but all on a senior discount.
No.
Good. She was really struggling.
It was, yeah. So then I go back in. I'm like, these groceries aren't mine. And they go, oh, that's going to take a minute. We're going to have to go pull those items off the rack. Like go find the Folgers coffee and the Diet Coke and all this stuff and scan them so we can refund them. I go, no, I do not have time for that. Melissa's teaching a class at 6:02. Prompt. I'm ready.
Okay, am I starting or Becky, did you want to say anything? I don't know.
Why don't you go ahead and start?
Okay. So welcome everybody to our CPP and FPC study group. This is night 1. Mannon sent out a pre-test earlier in the week so you could kind of see what you know and what you don't know. She sent the answers with it. So tonight we're gonna just talk about the pre-test, see if you had any specific questions, but keep in mind that's what you're supposed to be learning over the course of the next 3 months. And then we'll do some concepts for payroll, introduction to payroll. We'll talk about employees versus independent contractors, talk about verification of employment, the Fair Labor Standards Act, and then some employment forms that you get during new hire. So first of all, did anybody have any specific questions on the pretest? Again, I'm not going to go through every answer because that's the things that you're supposed to learn. If you took it, did you do good? Anybody?
Hey, for sure.
Sorry, I didn't take it.
Angela,
Yeah.
you should have gotten 100%.
I should.
Make sure you
Should.
unmute if you want to answer.
I had not hand calculated with the percentage method since they changed the W.
Wow.
So doing the deduction of 4,000 instead of the 2 dependents, that I had to figure that one out.
Yes, I bet that was different. All right, so keep those around, and then at the end of the class, you can retake it, and hopefully you'll do much better. Okay, so let's get right started. When you are being hired by a company, they are going to request some documents from you. Those documents are going to include, most likely, your social security card, an I-9 form, a Form W-4, which is the federal form. Depending on the state where you work, you may also have to include additional withholding forms. For example, here in Colorado, we do not have an additional form, but some other states do. And it's really important that your employer keeps the information secure. Of course, we all know that fraud is running rampant, and COVID didn't help that. It's getting even worse. So your employers need to be very careful and make sure that they keep all of your data secure. So the first thing is your social security card, and your employer should use that to ensure that you have a social security number and that you are authorized to work in the United States. They need to verify that the name matches your social security card. And if you have an incorrect social security number identified, your employer is required to make 2 annual solicitations for the correct social security number, and those must be made by December 31st. So oftentimes, especially with ACA filing and things like that, we get notification from the IRS that there's a possible incorrect social security number, and your employer must do their due diligence to make sure that they go to the employee and ask at least twice and make sure they have documentation of that before December 31st. The Form W-4, we are all super familiar probably with the new Form W-4 that has recently come out that is very different than the old Form W-4. Your employer should ask for that and you should fill it out. It is used to calculate your federal income tax owed and deducted each pay period. The employer should keep a copy of that so that they can always refer back to it. And you as an employee are able to submit new Forms W-4 should your withholding situation change. The social security number, employers are always encouraged to verify that using one of the systems available. E-Verify is definitely the most common one that's available for employers to use to verify social security numbers. So methods of payment for employees, although it is, most of us probably have direct deposit. Your employer could also issue you a physical check. Pay cards are also available for those employees that do not have bank accounts, and they can be used like cash, like a debit card. And then your employer could pay you in cash. It's probably pretty unusual, but it can be done. So taxes have to be withheld from your paycheck. And working in the United States, the most common taxes that are withheld are federal income tax, employment taxes, which are Social Security as well as Medicare, and then state income tax, depending on the state that you're working in. Colorado, we have state income tax. Other states, Texas, Washington, things like that, they don't have any state withholding tax. And then there's other taxes that may or may not need to be withheld, and those can include local taxes. Some states have employee portions of unemployment or workers' comp, paid family leave, which we will be experiencing here in Colorado soon, and disability. There are, I believe, 5 states in the United States right now that have state disability withholding. Your employer withholds the taxes from your paycheck, and then they send that money directly to the tax agencies. So payroll is tough for those of us that do a lot of it. And reasons that it can be tough is that it's very complex. There's many laws, and those laws have been changing, of course, this year a lot. And it makes it hard it just makes it very complex to keep regulations all intact and that you're making sure you're in compliance with all of those. You have to comply with federal as well as state laws. Generally, state laws are more strict than federal. They cannot be less strict than federal. Communication is also a challenge with payroll. Paychecks or pay statements are not always the most clear thing for an employee to read. And so trying to communicate to them how they were paid, explanations of what their paycheck looked like, all of those things can be difficult and challenging for those of us that work in payroll. Technology is huge, especially as we've learned here through COVID. Many of us are now working remote and having Zoom meetings versus sitting around a table and chatting like we used to do. So very different. Automation of timekeeping and things like that with employees that are working remote or not at your location, not being able to physically use a time clock, things like that are all challenges that come with payroll. And then accuracy. And as we all know, anything less than 100% with payroll is not acceptable. And your employees want to be paid correctly, accurately, and timely. So that can be very challenging at times. So the payroll process in its most generic form is that you have the employee, you hire them, you have to report them as a new hire. They have time data, they have a form W-4, they have a form I-9, all of that has to get entered into whatever payroll software that you are using. Once that's complete, you have to actually process payroll. You have to input the payroll, you have to verify it's correct, you have to process the payroll, you have to run reports, you have to reconcile, all of those fun things. You also have to make tax deposits to federal agencies as well as state agencies. You have to file reports. Becky was just saying she's done with her quarterly reporting for fourth quarter. Good for her, that's awesome. You have to reconcile all of those things. And then the employee gets a W-2 at the end of each year that they have to report with for their personal income tax withholding. And then of course they get pay statements with each payroll. Worker classification has become a big deal in recent years. People or employers that are misclassifying employees as independent contractors can have huge fines associated with that. So it's really important that you know and you are very diligent about making sure that you're classifying your employees correctly as employees versus independent contractors. Once you've identified that you have an employee, there is exempt versus non-exempt, and that goes along with FLSA. So employees versus independent contractors. Designating a worker status as an employee or independent contractor is the responsibility of the employer, not the worker. So it's important that as the employer, you make sure that you are designating those correctly. There are a couple of tests, the common law test and the reasonable basis test. If you are unsure as an employer, you can submit a form SS8 to the IRS to help you determine whether the employee should be an employee or an independent contractor. To be safe, while that is in process, they recommend that you treat the employee as an employee and not as an independent contractor. The tax consequences are huge for an employee versus an independent contractor. There's way less tax for the employer for an independent contractor. So the common law test, we have employees, we have independent contractors. An employee is required to comply with the employer's instructions about when, where, and how to work, versus an independent contractor who sets their own hours, determines their own sequence of work. An employee works exclusively for the employer. An independent contractor, on the other hand, oftentimes works for several employers, and their services are available to the public. An employee is hired by the employer. An independent contractor is self-employed. An employee is subject to dismissal, and they can quit without liability. An independent contractor has a contract that governs how the relationship can be severed. An employee has a continued relationship with the employer. An independent contractor, on the other hand, works by the job. An employee, work is done personally by the employee. An independent contractor, on the other hand, is permitted to employ assistants to help them get the project done. An employee performs services under the company's name. An independent contractor performs services under the worker's business name. An employee is paid a salary, reimbursed for expenses, can participate in the company's fringe benefit programs, versus an independent contractor who is paid by the job and they have the opportunity for profit as well as loss. The employee is furnished tools, equipment, materials, and training by the company versus an independent contractor who furnishes their own tools, their own equipment, and their own training. The employee, if it's an outside salesperson, the company provides leads, sets terms and conditions of the sale, assigns a territory, and can control the sales process, versus an independent contractor that would control the sales process and terms themselves. So those are the common law, that's the common law test to decide whether you have an employee or an independent contractor. The IRS has streamlined the process for making worker classification determinations by identifying factors that clearly indicate the degree of control or independence in the relationship of the worker. So these three categories are what the IRS considers. Behavioral control, it's the right to direct or control the means by which the worker performs the work to be done. Detailed instructions for completing a job tend to reflect an employer-employee relationship. So if you are giving detailed instructions to someone on how they are to complete a job, most likely they should be an employee, not an independent contractor. Financial control. If a worker has made a significant financial investment in the job, has business expenses that are not reimbursed, or has made the services available to the general public, the worker may be considered an independent contractor. So if they have financial, they invested in the job and their business expenses are not being reimbursed, then they are probably considered an independent contractor. And then the third piece is the relationship of the parties. The relationship of the parties is determined by examining how the worker and the employee perceive their relationship. If a Form W-2 was filed for the worker, or if the worker received benefits under the employee's benefit plans, the worker is an employee. So practice. Food for You is a caterer, and they provide full party catering services. They hire bartenders and wait staff from a local union organization. Bartenders and wait staff supply their own uniforms. What do you think? Employee or independent contractor?
And I do want to point out that this class is for RCH credit if you already have your CPP. So make sure if you want your CPP, if you want your RCH credit, we have to have a record of participation.
Hang on, sweetie, I've got to, I'm working, just a second.
Type your name and the answer to the question in the chat so we have a record of that and you can get your RCH credits. You'll get 3 credits for tonight's class.
Perfect. What do you guys think? Employee, independent contractor?
It's an employee.
Employee.
I would agree. Just because they supply their own uniform is not enough to make them an independent contractor.
So what's the criteria again?
For what?
An independent contractor. So isn't there a few tests, or maybe we'll cover that later, like financial tests?
Yep, we've just went through the common law test as well as the behavioral control, financial control,
Yep.
and the relationship of
Yep.
the parties.
Perfect.
So here's a different scenario. Elizabeth's Auto Mart provides a garage with 2 bays for Diane to perform car services. Diane provides all of the supplies needed to perform all of Elizabeth's Auto's work needs. Diane also solicits business from insurance adjusters and others. Diane hires her own workers, that's their work hours, and can fire them for poor performance. All repair prices are determined by Diane, and she receives a percentage of the gross revenue of the work completed at the shop. Any uncollected charges are Diane's responsibility. What do you guys think? Independent contractor or employee?
It's an employee.
Employee.
Just too much control, financial control. Controls their hours, can hire and fire.
Great.
But wait a minute, I'm sorry. Can you go back to that one? Isn't Diane the person performing the work? And she's providing her own supplies?
Mm-hmm.
That was my question. It was,
I'm reading
they
that.
provide the garage to Diane.
So I guess it
That was
depends
my
if you're
question.
thinking of Diane. Is Diane an independent contractor or are Diane's employees an independent contractor? So I would say that
I was
Diane
thinking
is
Diane.
right. I would say Diane is an independent contractor for Elizabeth's Auto Mart because all she does
Right.
is uses their
Yeah.
garage to perform the work. But Diane then does hire employees under her, and they would be her employees, not independent contractors of Elizabeth's Auto Mart. Does that make sense?
So Diane owns
Yeah.
Elizabeth Auto Mart, but she,
No, Diane rents from Elizabeth Auto Mart.
Yes.
okay. So we're saying Diane's employees. I'm sorry.
I was
So,
Okay.
right. Diane would be an independent contractor of Elizabeth's Auto Mart, and the employees of Diane are employees of Diane, not of Elizabeth's Auto Mart. Does
Right.
that make sense?
Yeah.
Okay, so there is also the reasonable basis test, and this is for exceptions to the common law test. So, if you may treat a worker as an employee under the common law test as an independent contractor, and they would be exempt from federal tax laws if they have a reasonable basis for doing so. So the reasonable basis test says, have they consistently been treated as independent contractors in the past, and have 1099 Form NEC been filed on them in the past? Have longstanding recognized practice in a significant segment of the employer's industry of treating similar workers as independent contractors. Have a judicial precedent for treating workers in similar circumstances as independent contractors. Have to be able to demonstrate that the IRS has ruled in a published ruling that the workers are independent contractors, and the facts relating to the workers are the same as the examples in the published ruling. Have received a specific ruling from the IRS that the workers are independent contractors, or you have had a past IRS employment tax audit of the employer that did not disallow the worker's treatment as an independent contractor, or you have received guidance from an attorney or a CPA that the worker is an independent contractor. So that's the second piece.
So can I ask you a quick question? Does anybody know what's happened with Uber and Lyft? Are they independent contractors or employees now, based on the lawsuits?
I don't know.
I don't know.
And this is a perfect example of statutes, right? What did the IRS say? I think in California, they've said that they're employees. But anyway.
Right.
So my 2 cents.
Okay, so there's also temporary service or leased employees. Organizations may have individuals who are not classified as either employees or independent contractors performing services. These individuals generally are employed by organizations described as temporary service agencies, leasing companies, or PEO, professional employer organizations. These organizations bear the burdens of an employer. They have to pay, withhold, report, and provide benefits. The company receiving the services contracts with the temporary service agency or leasing company, not with the individual workers. Professional employer organizations. The Tax Increase Prevention Act of 2014 requires the IRS to establish a voluntary certification program for PEOs. They This tells, so a PEO is treated as the employer of any covered employee, but only with respect to remuneration paid by the PEO to the covered employee. Federal tax exemptions and exclusions and definitions and other rules. So for federal tax purposes, the exemptions, exclusions, definitions, and other rules based on type of employer that apply to remuneration remitted by a PEO to a covered employee are presumed to be based on the customer for whom the covered employee provides services. Annual wage base and withholding threshold for FICA tax and FUTA and the additional Medicare tax. For purposes of applying the annual FICA and FUTA wage bases and the withholding threshold for the additional Medicare tax, remuneration received by a covered employee from a PEO for performing services for a customer of the PEO within any calendar year is subject to a separate annual wage limitation, contribution base, and withholding threshold that are each computed without regard to any remuneration received by the covered employee during the calendar year from another employer. However, a PEO is treated as a successor or predecessor employer for purposes of the annual wage limitations and contribution base upon entering into or terminating a PEO contract with respect to a worksite employee. So PEOs must meet all of the reporting requirements applicable to employers, just 941s, 940s, all of those things. Misclassifying workers. I said at the beginning when we started talking about employees versus independent contractors that those penalties can be huge for misclassifying employees. So if you misclassify an employee as an independent contractor, your company can have significant problems. They can be, potential loss of revenue for everybody involved. It's a big deal to misclassify employees. So again, we've already talked about those three tests: the behavioral control, the financial control, and the relationship of the parties. So it's very important that you think about those things and make sure that you're classifying the employees correctly. The penalties for unintentionally misclassifying an employee as an independent contractor can be 1.5% of wages paid. This is doubled to 3% if the employer did not file any returns. So if they classified somebody as an independent contractor and then they did not file a Form 1099, then the penalty is doubled. The employer's share of Social Security and Medicare, the penalty is 20% of the employee's share of the tax. And again, it's doubled to 40% if the employer failed to file Forms 1099. On the other hand, if you intentionally misclassify an employee, then the employer will be liable for the full amount of federal income tax that should have been withheld and 100% of the employee and the employer's share of Social Security and Medicare. So that can get incredibly expensive fast. So there's a voluntary classification settlement program available to employers who voluntarily change the classification of their workers. So if you realize you've misclassified somebody, if you qualify, you can be part of this voluntary classification settlement program. And your penalties are reduced. So you will pay 10% of the employment tax liability that may have been due on compensation paid to workers in the most recent year. You will not be liable for penalties and interest. You will not be subject to employment tax audit with respect to the worker classification for prior years. And you will agree to extend the period of limitations on assessment of employee tax for 3 years. So if you qualify for that, that's good news for you because those penalties are going to go down.
This might be a silly question, but do you remember having to know those percentages for penalties for the CPP exam?
I don't specifically specifically remember that on that particular one. I do remember having to know specific percentages or amounts for other specific penalties, like failure to report W-2s in time and those types of things. So I think it's definitely potential that they could ask that.
Okay, thanks.
So if you have an independent contractor, then you should request from them a form W-9, which is how the independent contractor gives you their TIN, or their taxpayer identification number, which depending on how they file with the IRS could be their social security number, or it could be an FEIN. And you can check those verified using the IRS TIN matching system, which is always smart. If an independent contractor does not provide you with a taxpayer identification number, then you are required to calculate and withhold backup withholding, which is 24% on non-wage payments. So a statutory employee versus a non-employee. Statutory employees are workers who are not employees under the common law test. They're treated as employees for certain employment tax purposes. Payments made to statutory employees are not subject to federal income tax withholding, but they are subject to Social Security and Medicare tax withholding. The employer must also pay its share of Social Security and Medicare taxes, and in some instances, federal unemployment tax. So statutory employees will fall into generally one of four categories: agent drivers or commission drivers, full-time life insurance salesman, home worker, not to be confused with domestic employees, and traveling or city salesperson. So the general requirements for workers who fall into these categories are that all services are performed personally by the worker. The worker must not make a substantial investment in business equipment or facilities. And work must be part of a continuing relationship with the employer rather than a single transaction. So it has to happen over and over again. It can't just be a one-time thing. Statutory non-employees qualify as employees under the common law test, but are treated under the Internal Revenue Code as independent contractors. Their earnings are not subject to federal tax withholding or Social Security, Medicare, or FUTA as long as certain requirements are met. And those requirements are generally, they fall into two categories. They're qualified real estate agents and or direct sellers. And then the general requirements for that is that the majority of their compensation is directly related to sales or other work output rather than hours. And work performed under written contract, that worker will not be treated as an employee for federal income tax, Social Security, Medicare, and FUTA. All right, so when you as an employer hire people, you have to report them as new hire. There is federal reporting requirements, and there also could potentially be different state reporting requirements. So each employee must provide name, address, and Social Security number. In the new hire reporting, the employer's name, address, and FEIN must also be included. The date of first date of services for the employee. Some states request more information. For example, Colorado requires birth date. A rehire must report when the worker was separated from employment for at least 60 consecutive days. So if somebody quits or is terminated or whatever the situation is, if they come back within 60 days, you do not have to report them again. But if they've been gone for more than 60 days, you do have to report them. Some multi-state employers choose to report their new hires to a single state instead of reporting to each state, which is more convenient for the employer. Reporting must be completed within 20 calendar days of the date of hire. And employers may, again, use a Social Security number verification service, such as E-Verify, that's the most common one, to verify the employee's name and Social Security number. It is not at this time required. It has been put out there that maybe someday it will be. All right, pop quiz. What have we learned so far? Excuse me. So what taxes, if any, must be withheld from employees' pay?
A. Well, C, really. I vote for C.
I guess you
Depends,
could have
could
that
be A.
argument.
At least C, but more commonly A.
Huh.
I mean, you at least got to do C. But
That is true. You do have to do C. I mean, yes, you do have to do C. I
Okay,
believe the
yourself.
book has A as the correct answer. What about independent contractors?
No taxes.
No taxes. I would agree. Whose responsibility is it to determine whether a worker is an employee or an independent contractor?
The employer.
Correct. A receptionist has agreed to work afternoons at the company until the company can find a full-time replacement. What is the receptionist's status? Are they an employee, an independent contractor under the common law, or an independent contractor under the reasonable basis test?
Just an employee.
I would say
Employee.
employee. Yep. Prior to beginning work for a company, a chemical engineer signed a contract stating that she agreed to work as an independent contractor. She performs all her duties in the company's laboratory, where she has full access to the company's testing equipment. She works under the company's discretion and maintains regular office hours. What is her status?
Employee.
A retired safety inspector for the company was rehired as a consultant when the company expanded its plant operations. The retired employee was a natural choice. The tasks he undertook as a consultant were the same as the ones he performed before retirement. Paid monthly, he has agreed to work under the discretion of his old boss until the new plant facilities are fully operational. What is his status?
Yeah, employee.
So here's the book answers, which of course is what the test is going to be based off of. How'd you do? Okay. So let's look at the Fair Labor Standards Act. The Fair Labor Standards Act of 1938, as well as state wage hour laws, govern the payment of wages to employees. The FLSA guarantees employees a minimum wage, requires employers to pay overtime premium, limits when minors can work, and provides equal pay protection. The FLSA is administered by the Wage and Hour Division of the U.S. Department of Labor. In addition, most states have enacted laws governing minimum wage, record keeping, child labor, equal pay, and overtime pay. The FLSA does not require vacation, sick, jury duty leave, holidays, lunch, or coffee breaks. It does not regulate how often employees must be paid. And it does not restrict hours for employees over 16 years of age may be required to work. Generally, those items are all regulated by state laws. So as we all know, in Colorado, for example, you have to be paid within 10 days of the end of the pay period. All of those things are laws that are Colorado laws, not necessarily federal laws. So exempt employees versus non-exempt employees. Not all employees are subject to the minimum wage and overtime requirement of the FLSA. Employees who meet certain criteria are exempt from minimum wage, overtime, and some record-keeping regulations. Employees who are covered by FLSA's minimum wage and overtime requirements are called non-exempt employees. Those who are not covered by FLSA's minimum wage and overtime requirements are called exempt employees. So exempt employees do not have to be paid a minimum salary, a minimum wage or overtime pay. Usually they're paid salary. They are not protected by FLSA, and the employer does not have to keep certain records detailing their work. Non-exempt employees, on the other hand, must be paid at least minimum wage for all hours worked, and at a minimum, an overtime premium must be paid for hours worked over 40 in a work week. State laws often have more specific or more strict laws than that. For example, here in Colorado, if you work over 12 hours in a day, you get overtime. In Alaska, I believe it's over 8 hours in a day. In California, I believe it's over 8 hours in a day. We all know California has crazy laws. So those laws can be more strict at the state level. So if we are looking at employees that can be exempt to FLSA, there are several different categories of reasons that they can be exempt. And one of those is the white collar exemption. For executives is one qualification. So for an executive employee to qualify as exempt, employees must meet the following requirements. Their primary duties must be management of the business or of a customarily recognized department of the business. They must regularly direct the work of at least 2 or more full-time equivalent employees. They must have the authority to hire and fire other employees, or their recommendations must be given particular weight as to the employment status changes of other workers. And the employee must be paid a salary of at least $684 per week. Any employee who is employed by and owns at least 20% of an enterprise, regardless of salary level, is an exempt executive. So another white collar exemption is administrative employees. To qualify as an administrative employee and the white collar exemption, the following requirements must be met. Their primary duties must consist of performing non-manual or office work directly related to management or general business operations of the employer or the employer's customers, or their performing work directly related to academic instruction or training carried on in the administration of a school system or educational institution. Administrative employees' primary duty must include the exercise of discretion and independent judgment with respect to matters of significance, and they also must be paid a minimum of $684 per week. Examples of some administrative exempt employees: insurance claims adjusters, financial services employees, team leaders, executive assistants, HR manager, purchasing agent, inspectors or graders, retail store buyers. We also have professional exemptions. There's a couple different categories for professional exemptions. One is learned professionals. Learned professionals are, they have to have a specific level of specialized advanced instruction before they can be considered a learned professional. There are also creative professionals whose primary duties involve the use of originality or creativity. So here's some examples of those. Learned professionals: nurses, registered or certified medical technologists, dental hygienists, physician's assistants, accountants, chefs, paralegals with specialized degree, athletic trainers, funeral directors, or embalmers. Creative professionals: actors, musicians, composers, conductors, soloists, painters, cartoonists, essayists, novelists, short story writers, journalists, chefs, teachers, lawyers, physicians. So the work of either of these groups of professionals must be intellectual and varied, not standardized. The minimum weekly salary an exempt professional employee must be paid is $684 per week. Teachers, engineers, and attorneys are examples of professional employees. They are highly skilled. Those working in highly skilled computer software occupations fall into a separate category of exempt professional employees. The primary duties of exempt computer professionals must include systems analysis, system program design, or computer programming. To qualify, employers must be proficient in their field. The same minimum threshold salary of $684 per week is applicable. But for computer professionals paid by the hour, they also may be exempt if their hourly rate is at least $27.63. The salary requirement does not apply to exempt professionals who are licensed to practice law or medicine and are actually doing so, medical interns or residents, or teachers working in an educational institution. Outside salespeople can also be exempt from FLSA. They are exempt if they meet two requirements. One, they are customarily engaged in selling or getting orders for the company's product or service. And two, they work away from the employer's premises. There is no salary requirement for outside salespeople. The minimum salaries and duties required for exempt employees listed above may be superseded by applicable state laws. So state laws may have more strict regulations on that than the Fed. So there's some special exemptions as well. In addition to the four categories of the white collar exempt workers that we just talked about, there are other exemptions potentially from FLSA. Various transportation workers, agricultural workers, hospital and home nursing home workers, home companion care workers, and public sector employees like firefighters, police officers, and others. All exempt employees are exempt from FLSA regulations concerning overtime or minimum wage. Non-exempt employees must be paid the minimum wage and overtime. Highly compensated employees earning $107,732 or more, including base salary of at least $684 per week, commissions, non-discretionary bonuses, and other non-discretionary compensation, but not including the cost of employee benefits. Performing non-manual work will be exempt if employee regularly performs one or more of the exempt duties of an executive, administrative, or professional employee. One catch-up payment may be made during the last pay of the year or 1 month after the end of the year or within 1 month after termination to make up if they didn't make that salary. You can make one payment to get them up to that. Exempt employees must be paid their full salary regardless of quantity or quality of work. Rules prohibit deductions from exempt salaries pay for partial day absences. Deductions for absences are allowed if regular pay is supplemented by a paid leave policy. Deductions can be made for workplace misconduct. Extra pay is okay. Under FMLA regulations, exempt employees do not lose their exemptions merely because employers provide unpaid FMLA leave of less than a day. The leave must qualify as FMLA leave, though. So federal minimum wage. The federal government and many states have set minimum wage for non-exempt workers. The minimum wage applies to workers' hourly compensation, not to their net pay. Thus, after deductions, a worker's take-home pay may legally fall below the required minimum wage. The federal minimum wage, which has been effective since 2009, is $7.25 per hour. Employees under age 20 can be paid $4.25 per hour in their first 90 calendar days on the job. Federal government contractors must pay a minimum wage of $10.80 for hours worked in 2020. The Department of Labor has established civil penalties for violations of FLSA's minimum wage or overtime requirements. And those penalties are adjusted annually for inflation. For violations occurring after November 2nd, 2015, civil penalties assessed after January 15th, 2020 include the recovery of back wages and equal damages, and for repeated willful violations of penalty up to $2,050 per violation. The work week, the Department of Labor's wage and hour division is the basic unit of time for determining wages that must be paid under the FLSA. Must include 7 consecutive 24-hour periods, and it may differ from the pay period and can vary between employees and does not have to begin at the start of a day. So your work week can start whenever you want, and it can be different for different employees within your company. It may be different from your pay period, which can get very confusing to employees. If a single employee does some work covered by the FLSA and some work not covered in a single work week, all pay must be compliant with FLSA. Work cannot be segregated in a single work week. Effective 1/1 of 2020, federal contractors are subject to the minimum wage of $10.80 per hour, and tipped employees must be paid $7.55.
Melissa?
Yeah.
Do you know of many states that don't have their own minimum wage above what federal is?
There are a few. Most of them are above federal minimum wage. I would have to look specifically, but there are a few that do not have one that is greater than federal minimum wage of $7.25 per hour. Ohio is coming to mind, but I don't know that for sure. But there are some. Many states have set their own minimum wage higher than $7.25 per hour. If the employer is covered by both state and federal law, and the two are not the same, the employer is required to pay the higher minimum wage based on the state in which the employee works. So, for example, if you work in Colorado, your employer cannot pay you $7.25 an hour because it's the federal minimum wage. They must pay you now $12.32 an hour because that's Colorado's state minimum wage. So wages other than cash may be included in minimum wage calculations. Taxes and other withholdings, the cost and maintenance of required uniforms, room, board, or other facilities provided may be used to bring employees' cash wages below minimum wage, but only if the following are met. The employees benefits from the facilities and accept them voluntarily. The facilities be supplied regularly, and they must benefit the employee, not the employer, and only a reasonable cost can be deducted. Like your employer can't make a profit off of that deduction. Tips are another piece of the FLSA. The FLSA defines a tip as an amount presented by a customer as a gift or gratuity in recognition of a service performed. The tip is to be distinguished from a payment of a charge for services performed. So a restaurant's waitstaff may be paid at a rate less than federal minimum wage because they get tips. So the sub-minimum wage applies to waitstaff, bartenders, and some other workers who typically earn tips in addition to the wage. In such cases, the employer may be able to reduce these employees' hourly rate to $2.13 per hour. The tip credit can be used to reduce those employees' hourly rate only if the employee regularly receives more than $30 in tips per month. So here's an example of the tip credit. So Jim's Grill has employees who receive tips. The grill pays the employee $2.13 per hour. During the work week ending May 15th, Mike worked 30 hours and received $80 in tips. So he worked 30 hours and got paid $2.13 per hour, so he got paid $63.90. He earned $80 in tips. So to figure out his rate of pay, his regular rate of pay, we're going to add those two things together and we get $143.90. then divide by the 30 hours that he worked, and we get $4.80 per hour for his regular rate of pay. So the question is he owed more money? So if he was being paid minimum wage, federal minimum wage, he would have made $7.25 times the 30 hours that he worked. And if you subtract the $143.90 that he made, that gives you $73.60. So if you take what he earned, his $143.90, and you add in the $73.60, you get $217.50, and his regular rate of pay would then be $725. So you do have to pay that extra amount to make sure that he is receiving the full $725 for the minimum wage requirement. So if you take the minimum wage, $725, and you subtract out the $213 for tipped employees, they call that difference the tip credit. So the federal tip credit is $5.12 per hour when the tips received by the employee are at least $5.12 per hour. So in other words, you can't, if they don't earn enough in tips, you have to pay them the difference to make up their wage so that it is minimum wage. Some state laws prohibit the use of tip credits. Other states have laws setting lower tip credit amounts than the FLSA. For example, Colorado, their tip credit amount is $3.02, so it is less than the federal. So we have to comply with that in Colorado because it's in the best interest of the employee. In order to take the tip credit, the employees must actually, for the employer to take the tip credit, the employees must actually receive at least as much in tips as the credit taken by the employer. The employees must be informed of the tip credit provisions before the credit is taken. All tips received by the employee must be kept by the employee, and credit card tips must be given to the employee by the next payday. So here's an example of a state that has a higher tip, or a lower tip credit, I should say, than the federal tip credit. If your state minimum wage is $8 and the maximum tip credit is 35%, then $8 times 35% is $2.80. So the state tipped minimum wage would be $5.20 per hour. And they have to pay that versus the $213 because it's more generous to the employee. So calculating regular rate of pay can be a challenge sometimes. Regular rate of pay is an hourly pay rate, and the rate of pay calculation only impacts non-exempt employees because their employees are not required to compensate exempt employees beyond their salary. So to find the regular rate of pay, you take the total regular pay and you divide by the total number of hours worked, which sounds super easy until you start throwing in all of the other pieces of compensation that can be included in the regular rate of pay. So the calculation of regular rate must include all compensation except that specifically excluded by the FLSA. So for the regular rate of pay, there is several things that go into the calculation. Shift premiums, although there is no federal or state requirement, some companies pay shift premium or shift differentials to employees who work non-desirable shifts. For example, if you work the graveyard shift, you may work more than somebody who works a 9-to-5 shift. Shift premiums must be included when determining the regular rate of pay for overtime. Bonuses also, employees may receive many different types of supplemental pay from their employers, such as bonuses, commissions, production pay, as an incentive for increased productivity. Under FLSA, these payments may be a factor in determining an employee's regular rate of pay for overtime purposes. And it may be a factor, they may also not be a factor. It depends on how the bonus is paid, whether it's discretionary or non-discretionary. Things that are not included in regular rate of pay is a gift. And a gift is defined by an amount paid to an employee on a special occasion. It is not included in an employee's regular rate of pay so long as the amount does not depend on hours worked, production, or efficiency. The amount may be different for each employee if it is based on a percentage of salary or length of service. Reimbursed expenses are also not included in regular rate of pay for things like travel and other business-related expenses incurred by an employee on behalf of the employer. Stock options, things like that are not included. Meals are not included generally. They can be if it is agreed upon. Show-up pay and callback pay are not necessarily included because they are not part of worked hours. So show-up pay is defined as compensation for a specified minimum number of hours at the applicable straight time or overtime rate for sporadic occasions in which the employee is not provided with the expected amount of work after reporting as scheduled. Payments for hours that are actually worked are included in the regular rate of pay, but amounts beyond what the employee would receive for the hours worked are excluded. The same with callback pay. And callback pay is generally an additional compensation for calling an employee back to work without a prearranged agreement. Okay. Overtime is also not included in the regular rate of pay. Paid time off is not included in the employee's regular rate of pay, nor are hours counted to determine if an employee works more than 40 in a work week, unless there are certain employers that have other provisions in their policies that could include those hours in the calculation, but that would be more generous than the requirement of the law.
Melissa,
Yes.
on that list, it said state and local regulated payments.
So state and local regulated payments are penalties for certain scheduling practices imposing a monetary penalty on employers in situations such as calling an employee to work without prearranging or scheduling. Any money an employer is required to pay as a penalty for such actions is excluded from regular rate of pay. The hours an employee actually works must be included. So that an example of that would be the meal penalty in California. It's not an actual hour that they worked. It's a penalty that the employer has to pay for not giving them a lunch break. Does that make sense?
Yeah, thank you.
Okay, sorry, I skipped that one. Been a long day.
It was just the one that I had a question about. I was like, oh, you didn't talk about it.
Oh, the bonuses?
Oh, no, the
Oh,
the
the other
stairs.
one. Yeah,
Yeah.
sorry. Okay, so bonuses, non-discretionary bonuses, as any contractual or agreed upon bonus related to production, efficiency, attendance, quality, or other measure of performance must be included in the calculation of an employee's regular rate of pay during the work weeks the bonus is earned. So some employers give their bonuses give their employees a bonus that was agreed upon based off of, say, their productivity. And if they do that, then whatever time frame that bonus was paid for, the employee's regular rate of pay must include that amount when it comes to their overtime. So the employer sometimes ends up having to go back and recalculate the regular rate of pay and then pay an additional amount due for the overtime work during that period because of the non-discretionary bonus. On the other hand, a discretionary bonus is bonuses paid for service performed that are not included in the employee's regular rate of pay if the employer has the discretion whether or not to pay the bonus and to determine the amount of the bonus. To be a discretionary bonus, the bonus must not be promised in advance by a contract or other agreement. The employer's discretion as to when to pay the bonus and the amount of the bonus must be made at or near the end of the period during which the services were performed. So that is not based off of a contract. It's not agreed upon by the employee and the employer prior to it happening. It's completely discretionary from the employer, and that does not have to be included in the employee's regular rate of pay. So as you can see with all of this stuff, that's why regular rate of pay sometimes gets complicated on actually calculating it. Overtime in excess of requirements. So if your company pays like double time or triple time for working more than 8 hours in a day, or you know, on Sundays in California, you're required to pay, oh, I guess it's 7 consecutive. If you work 7 consecutive days, all of your time on the 7th day is required to be paid at double time. So, and that's in excess of the regular normal overtime calculation for the FLSA requirements. And so the extra compensation can be excluded from the employee's regular rate of pay. Non-cash goods and services, the fair market value of goods and services provided to employees by the employer must be included in their regular rate of pay. So for an example, is lodging that an employer performs, or I'm sorry, furnishes for the employee as part of their compensation package. It must be included in their regular rate of pay. Benefit plans, so contributions made by an employer to a trustee or third person to a profit sharing plan or qualified retirement plan or insurance plans or something like that, they are not included in regular rate of pay. They are excluded. Retroactive pay. Retroactive pay increases an employee's regular rate of pay, and it must be prorated over the period covered and overtime calculated on the new regular rate. So that does have to be included. Okay, so let's talk about Mo. Mo's basic rate is $10 per hour and his work week is Sunday through Saturday. Normally, Mo doesn't work weekends, but when required to work on Sunday, his employer pays him double time. In one work week, Mo was required to work 4 hours on Sunday. The remainder of the week, Mo worked 37 hours. Since Mo worked a total of 41 hours during the work week, under FLSA, he is due an hour of overtime pay. However, since the double time pay was more than the requirement by FLSA, the double time pay can offset the required 1 hour of overtime pay. So per FLSA, he worked 41 hours at $10 an hour, which is $410. Then he worked 1 hour over the 40 in a week. So he gets 1 hour of overtime, and his overtime premium is half of his regular rate of pay. So half of 10 is 5. So the total he would have gotten paid would be $415. But Mo's employer is super nice, and he paid him 37 hours at $10 an hour. And then he paid him 4 hours at $20 an hour for that double time. And so 370 plus 80 is $450. And since the $450 is higher than the FLSA's requirement of $415, then they're good to go. They have overcompensated the employee instead of undercompensating. So they are all set. All right, here we go. Pop quiz. What are exempt employees exempt from?
Minimum wage and overtime.
You're awesome. All of the following types of employees are classified as exempt from FLSA's minimum wage and overtime requirements, except which one? Professional, outside salesperson, administrative, or a computer repairman.
Outside salesperson.
Any other ideas?
I would do D.
Computer
repairman.
repairman?
I would say computer repairman is not exempt from FLSA. The other ones do fall under those categories. A waitress is paid $225 per hour and receives $225 in tips during the week. She works 40 hours per week. Which of the following is true? Her employer is allowed to reduce her cash wage to no less than $2.13 per hour. Her base pay must be increased to $4.25 per hour after a 90-day training period. She must be paid $5.12 per hour by her employer. Her base salary must be raised to $3 per hour to comply with federal minimum wage requirements.
Is it A? No.
So if you do $2.25 times 40 hours plus the $2.25 she earned in tips, she gets $315 for the week. And she worked 40 hours. So if you divide that by 40, you get $7.87 or $7.88-ish an hour. So she made more than minimum wage. Agreed?
Yep.
So for A,
A.
yeah, that's what I think it is. If a state sets minimum wage at a rate greater than the federal minimum wage, the state minimum wage must be paid to workers. True, false?
True.
True.
Agree. A non-exempt employee works in a state with a minimum wage of $7.35 per hour while living in a state with a minimum wage of $8.05. What is the minimum rate he must be paid?
Where the work is performed.
Where he works.
Correct. Yep. Tips can be counted toward an employee's minimum wage. True or false?
True.
True.
Yep. An employee works 40 hours per week as a fry cook. During the week, she substitutes for one of the waitresses and reports $5 per week in tips. Can her employer pay her $2.13 an hour?
No.
No.
No, they can't. There's a minimum, first of all, there's a minimum tips requirement to be able to use the tip credit, and $5 is not near close enough to be able to do that. Employers who provide paid vacation leave must count the hours of paid time off when determining if an employee must receive overtime premium when the total hours worked in a week exceed 40.
No. False.
No, it's
Agreed.
worked.
Hours worked is the key word. Good job. The FLSA requires immediate payment of an employee's final paycheck upon termination.
False. That's determined by the state.
False.
Right?
That is exactly right. Determined by the state. Good job.
Hey, I have a question. I'm the only one putting in the little comment thing. Do we have to do that or not?
For it, it's for a record for your your RCH credit.
Okay, so nobody else is gonna get credits?
They should be typing them in there. We also have
Okay.
this recorded, so if you're speaking up, then that I guess we could argue that is your participation as well.
Okay.
Thank you.
Okay, so work week. The work week is defined by FLSA as a fixed recurring period of 168 consecutive hours, which is 7 days times 24 hours per day. The employer's work week need not coincide with the calendar week nor the pay period. It may begin on any day of the week at any hour of the day. For example, all of the following could be considered a work week: Sunday through Saturday, Monday through Sunday, Saturday through Friday, any of those. Employers may establish a single work week for the entire organization or different work weeks for various groups of employees. Each work week stands on its own an employee who works 35 hours in 1 week and 60 hours in week 2 is paid overtime on the 20 extra hours worked in week 2. There are exceptions for hospitals, law enforcement, and fire protection workers, as explained here in the next couple of slides. So changing a work week is not always easy. The FLSA encourages employers to establish a permanent work week, but sometimes we do have to change a work week. And if that is the case, to ensure that employees receive all overtime pay to which they are entitled when work weeks change, several steps must be taken. You must add overlapping days to the old work week, then calculate overtime hours and pay for both the old and new work weeks. Add overlapping days to the new work week, then calculate overtime hours and pay for both the old work week and the new work week, and pay the employer the greater amount from step 1 or step 2. So the key is that it always has to be in the employee's best interest, not in the employer's best interest. So if you can avoid moving work weeks, that is good, but sometimes it does have to happen. So assume that an employer changes its work week from Monday through Sunday to Sunday through Saturday. A non-exempt employee works the following hours during a 2-week period. The overtime calculation is as follows. So if we add the overlapping day, which is Sunday, to the time worked during the old work week, we would get 40 hours plus 8 hours, which is 48 hours. If we add the overlapping day to the time worked in the new work week, we have 8 hours plus 32 hours equals 40 hours. So in order for this to be in the employee's best interest, you're required to pay the overtime based on the greater of those two amounts, which is 48 hours. The 880 rule for hospitals and nursing homes. So the FLSA provides hospitals and nursing homes an exemption from the requirement that overtime can be computed on a work week basis, which is known as the 8 and 80 rule. Hospitals and nursing homes can use a 14-day period to compute overtime. However, certain conditions must be met. First, the hospital or nursing home and the employee must agree to use the 14-day period instead of the 7-day work week for computing overtime before the work is actually performed. The agreement may be reached directly with the employee or with his or her representative. The 14-day period may begin at any hour of any day of the week, not necessarily at the beginning of a calendar day or week. The work period includes 14 consecutive 24-hour periods, and the 14-day period must be used permanently or for a substantial period of time. The employer cannot change back and forth between the 7-day work week and the 14-day period in order to reduce its overtime payments. Second, an employer is not required to compute overtime pay unless the employee works more than 8 hours in any workday in the 14-day period or works more than 80 hours in the 14-day period. The employer must calculate the overtime pay under whichever scenario provides the most benefit to the employee. So for example, Jack, a non-exempt hospital employee, has agreed to work on a 14-day period basis, and his regular rate of pay is $12 per hour. Jack works 5 days at 8 hours and 4 days at 10 hours each. His total hours worked are 80. His hours over 8 per day are 8. His regular earnings is 80 hours times 12 hours, $12 per hour, which is $960. And so his regular rate of pay is 12. His overtime premium then rate is 6. And so 6 times 8 is $48. So the total amount of earnings that he earned is $1,008. So interns are, the FLSA defines the term employee as to suffer or permit to work. So covered non-exempt individuals who are suffered or permitted to work must be compensated under the law for services they perform as an employer. Interns in the for-profit private sector will most often be viewed as employees unless the test related to trainees is met. So under training, This may apply to an intern who receives training for their own educational benefit. If the internship experience is for the benefit of the intern does not displace regular employees. The employer derives no immediate advantage from the activities of the intern. The intern is not necessarily entitled to a job at the conclusion of the internship, and the intern employer understanding is that the intern is not entitled to wages. So all of those things must be met in order for an intern to not be considered an employee. Fluctuating work week. There are many variations of the standard work week for many different regulations for each variation. For example, fluctuating work week plans require that the employee's work schedule vary so that neither the employee nor the employee can anticipate the schedule from week to week. The employee's salary must be set at a fixed amount, but must not fall below the current minimum wage when considering the number of hours the employee works each week. The courts have ruled that a fluctuating work week can be used when the employee is paid based on performance-based commission in addition to a fixed salary. FLSA permits these arrangements as long as employees are paid overtime for hours worked over 40 in a single week, and the fixed weekly salary is high enough to ensure that even when employees work a large number of hours, their hourly pay does not fall below minimum wage. So for example, George, a non-exempt employee, is paid a fixed salary of $400 per week and works between 35 and 50 hours each week. Last week, George worked 47 hours. His regular rate of pay is then going to be 400 divided by 47, which is $851. His premium overtime rate is going to be half of $851, which is $426. His overtime pay for the week will be 7 times that $426. And if we add the $400 that he got in salary plus the overtime pay, he gets $429.82 for that week. So compensatory time off in lieu of overtime pay. In the private sector, generally employers are not allowed to compensate employees for overtime worked in one work week by giving them time off in another work week, but there are some exemptions. Private sector employers are allowed to provide time off for employees who have worked overtime as long as the time off occurs within the same period, and employers give at least 1.5 hours for each overtime hour worked in the same period. So just like you have to compensate your employees at 1.5 times their pay rate per hour of overtime, you would have to compensate them equivalently if you gave them time off. So if they worked 1 hour of overtime, they get 1.5 hours of time off to compensate for that. It also must be given in the same pay period as the overtime is worked.
Is that paid time off?
What was that?
Is it paid time off?
Yes. Oh. Yes.
Okay.
In public sector, state or local government employees can give their non-exempt employees compensatory time off or comp time if certain conditions are met. The employee and the employer have an agreement. The comp time can be taken within a reasonable period. Comp time is paid out upon termination. Public employees' max accumulation of up to 240 comp hours which is the equivalent of 160 overtime hours paid at that 1.5 times their hours to make up for the time and a half. Public safety, emergency response, and seasonal activities for employees max accumulation of 480 hours of comp time. Again, that's 320 hours of overtime worked. Additional and occasional part-time in the same public agency. Employees may voluntarily trade time with another employee. and time spent by a court report preparing a court transcript is not considered hours worked for purpose of calculating overtime. So firefighters and police officers are exempt from FLSA. My husband is a firefighter and he used to be a police officer, so he has not seen overtime in a long time. Public safety employers, firefighters, and police officers are also covered by another exemption to the FLSA's overtime requirements, where firefighters and police officers have a work period lasting from 7 to 28 consecutive days. No overtime pay or compensatory time off is due until the ratio of the number of hours worked to the number of days in the work week exceeds the ratio of 212 hours to 28 days. 171 hours to 28 days for law enforcement officers. So there's that table that we have up there for their work days and their maximum hours that they could work before they're due overtime. The firefighter exemption also includes paramedics, emergency medical technicians, or EMTs, rescue workers, ambulance personnel, and hazardous material workers who are trained and engage in fire prevention and suppression to respond to emergency situations. This exemption allows public employers to spread hours worked for public safety employers over the entire work period, thus saving on overtime costs. Overtime is based on an employee's regular rate of pay, which must be at or above the minimum wage. The regular rate of pay is calculated by dividing all of the employee's pay for time worked during the work week, less the exemptions, by the number of hours worked in the work week. So again, we discussed already many of the things that go into the calculation of the regular rate of pay. It has to include base pay for all hours worked, non-discretionary bonuses, the fair market value of non-cash compensation, shift premiums, production bonuses, cost of living adjustments, retroactive pay, and all payments not specifically excluded by the law. And then it isn't, things that can be excluded are expense reimbursements, discretionary bonuses, employer benefit plan contributions, any paid time off for vacation, holiday, sick, things like that, special occasion gifts, and overtime, as well as stock options can be excluded. FLSA regulations require that all non-exempt employees be paid an overtime premium of 50% for any hours physically worked over 40 hours in each work week. Under FLSA, overtime is only paid for time worked, not all time compensated. Again, the key is hours worked. Overtime need not be paid when the worked time is less than 40 hours in a week, but the employee receives sick pay or holiday pay or vacation pay or something like that for time that was not worked. Under FLSA, the term hours worked includes all time an employee is required to be on duty, whether on the employer's premises or at a prescribed workplace. In addition, hours worked includes all time an employee is suffered or permitted to work, whether or not required to do so. Hours worked is not limited to active productive labor, but also may include waiting for work, remaining on call, or traveling on the employer's business. The FLSA does not require premium pay for weekends or holidays, nor is there overtime for more than 8 hours in a day, which some states have laws that do require those things, but it's not a federal law. Again, we've already talked about the exception for the firefighters, law enforcement, and hospital employees. And then the 80 versus 8 hour rule for hospital or nursing home employees. So calculating overtime pay, you're going to take all of the payments for the week for the regular pay and divide them by the hours worked. Then take the regular rate of pay and multiply by 0.5. This is your overtime premium rate. Multiply that rate by any hours worked in excess of 40 hours in the work week. And then the total pay for the week is the regular pay plus the overtime pay. So let's look at an example. Calculate the total compensation for an employee who worked 44 hours last week. In addition to his regular wage of $10 per hour, the employee was paid $50 for supervising a trainee. What is the employee's total weekly compensation? So if we take his 44 hours times his $10 an hour, plus his $50 in pay that he received for supervising a trainee, we get $490 of regular pay. To determine our regular rate of pay, we're then going to divide that by 44 hours that he worked, which if we round is $11.14. Then we multiply by 0.5 to get our overtime premium rate, which is $5.57. He worked 4 hours over 40 in the week. So we're going to multiply our $5.57 by 4 and get $22.28 for his overtime premium pay. So the total that he gets compensated for the whole week is $490 plus the $22.28 of overtime premium pay for a total of $512.28. So there's also the concern that an employee is compensated at more than one rate of pay in their work week. So the regular rate of pay must be at least the weighted average of all rates used in the week. For example, let's calculate the overtime for the following employee who was paid a shift differential for working different shifts. So on Monday, they worked 8 hours and they were paid at $8 an hour. Tuesday, 9 hours at $8 an hour. Wednesday, 8 hours at $9.50. Thursday, 10 hours at $10.50. And Saturday, 8 hours at $8 an hour. So if we do all that math and add that all up, we get $381 total, which is his regular pay. We're then going to divide that by the total hours he worked, which is 43. So his regular rate of pay is $8.86, multiplied by 0.5 to get our overtime premium rate is $4.43, times the 3 hours that he worked in excess of 40 for that work week means his overtime premium pay for the week is $13.29. And his total weekly compensation is those two things added together for $394.29. Overtime pay for piece workers can be potentially complicated. So when the employee works on a piece rate, the regular rate of pay is calculated by adding the additional earning for the work week from the piece rate to all other earnings, such as bonuses, and either of the following two methods may be used. So method one is once the regular rate of pay is determined, the piece worker must be paid in addition to the piecework earning for the work, an amount equal to 1/2 the regular rate times the number of hours worked over 40 in the work week. So for example, let's assume that a lathe operator earns $1 for each sheet of metal cut on a machine. Last week, the employee furnished 1,100 sheets and worked 45 hours. The overtime pay would be calculated as follows. So we're going to do $1 times 1,100 sheets, which gives us $1,100 in regular pay, divided by 45 hours worked, rounds to 24.44, multiplied by 0.5 to get our overtime premium rate, which is $12.22, times 5 hours of overtime, or 5 hours worked in excess of 40 hours in the work week. So the overtime premium owed is $61.10. And if we add that to our original regular rate of, or original regular pay for the week, then we get $1,161.10 for total weekly compensation. So the second method is that if an employee agrees to, before the work is performed, they may be paid at a rate not less than 1.5 times the regular piece rate for each piece made during the overtime hours. Other conditions must also be met to help guarantee that piece workers are not taken advantage of by their employers. For example, Sally receives $2.50 for each figurine she paints. In one 45-hour work week, she painted 140 figurines in the first 40 hours and 18 in the next 5 hours. So 250 times 140 is $350. 250 times 1.5 is $3.75. So she's getting $3.75 for the 18 figurines that she painted in the 5 hours of overtime work that she did. So her overtime earnings would be $67.50. So if you add her regular piecework earnings to her overtime piecework earnings, she gets $417.50. So commissioned employees, calculation for overtime. When a non-exempt employee is paid a commission, the regular rate of pay is calculated by adding the total earnings for the work week to the commission earned during the work week. So for example, if Rachel earns $8 an hour and is paid commission of 1% of her weekly sales, and in 1 week she works 46 hours and makes $1,200, her total weekly compensation would be $8 an hour times 46 hours worked is going to be $368, plus 1% of her $2,000 in sales commission is $20. So if we add those two things together to get our regular rate of pay, we get $388 in regular pay. Divided by 46 hours worked in the week, we get $843. Multiplied by 0.5 to get our overtime premium rate, which is $422. $422 times the 6 hours worked in excess of 40 hours in the week. We add those two things together and we get $413.32 for her compensation for the week. Calculating overtime for salaried employees. An employer pays a non-exempt employee a salary that is intended to compensate the employee for a specified number of hours per week. If the stipulated salary covers a period longer than a work week, such as a month, it must be converted to its work week equivalent. For example, a non-exempt secretary is paid $1,800 per month for working a 40-hour week. Calculate the secretary's total weekly compensation for a week in which he or she works 48 hours. So if we take the $1,800 a month times 12 months, we get $21,600 divided by 52 weeks. We get $415.38. Divided by 40 hours in the work week, the regular rate of pay is $10.38. Multiplied by 1.5 to get our overtime rate. So the reason we're using 1.5 instead of 0.5 as the calculation in step 1 is for that step 1 is only for 40 hours in the work week. So our $15.57 times the 8 hours of overtime that she would get for the week means that her overtime pay is $124.56 added to her regular rate gives us $539.94 for the week. All right, pop quiz. The FLSA requires that time work on Sundays be paid at overtime and time worked on Saturday be paid at overtime rates and time worked on Sunday be paid at double time. What do you think?
False.
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 Agree. If a state wage and hour law requires that a non-exempt employee be paid at an overtime premium when the employee works more than 8 hours in a day and the employee works the following schedule, how many overtime hours must the employee be paid?
2.
Agree. Last week, a high school teacher spent 40 hours in the classroom, worked 10 hours on grading papers, and was required to put in another 8 hours on Saturday at the school-sponsored science fair. Under the FLSA, what overtime hours, if any, must the teacher be paid?
Teacher doesn't have to be paid overtime.
Correct.
0.
I used to be a teacher. You don't get overtime pay, let me tell you that. An employer pays
Melissa?
Yeah.
You're still a teacher.
I I get paid overtime now though. An employer pays semi-monthly on the 15th and last day of the month. The work week is Sunday through Saturday. Memorial Day is May 31st. A non-exempt employee worked the following hours. How many hours of overtime, if any, did the employee work during this pay period?
Zero.
I don't have my 10 key.
Yeah.
Zero.
I agree, 0. During Thanksgiving week, a non-exempt employee was paid for the following hours. 10, 10, 8, 8, 8, 8. How many hours of overtime did the employee work?
0. Vacation hours are not calculated in overtime.
Perfect. When must overtime be paid?
Each payroll.
Each payroll.
Perfect. A non-exempt employee is working at a hospital, can work more than 40 hours in a week and not be paid overtime.
True.
True.
Payroll.
That is true because of the 8 and 80 rule. Good job. Oh my gosh, is it 8 o'clock yet? Can I stop talking?
That's a lot of talking. You're doing great.
Okay, so rounding, lots of employers like to round their time for their employees. The Wage and Hour Division has accepted the practice of rounding an employee's work time, especially where time cards and time and attendance systems are used, to the nearest 10th or quarter of an hour. The practice must be used consistently, however, so that employees are compensated over a period of time for all time actually worked. Work hours. Employees must be paid for working at their job sites. However, in many other situations, it may not be as obvious when employees are considered to be performing their principal activities. So a workday may be longer than the employee's scheduled shift, hours, tour of duty, or time on the production line. Workdays may vary from day to day, depending on when the employee commences or ceases principal activities. Preliminary or post-preliminary activities, such as changing clothes or washing up, that must be completed during a portion of the workday are compensable if defined as such by contract, custom, or practice. Principal activities include all activities that are an integral part of the principal activity, such as those that are so closely related as to be indispensable to its performance. The following activities are examples of integral parts of an employee's principal activities. At the commencement of the workday, the employee oils, greases, cleans, or installs a new part on a machine. An employee is required to report 30 minutes prior to other employees in order to distribute clothing or materials to the workbench of other employees. The following activities are not integral parts of principal activities. Punching in and out and waiting in line to do so would not ordinarily be regarded as integral parts of employees' activities. Passing through security devices and traveling to the job site. So meal periods, employers do not have to consider meal periods as working time if the employee is relieved of all responsibilities during the meal. Generally, meal breaks must be at least 30 minutes. Rest periods or coffee breaks, which are generally shorter than meal periods, typically are not longer than 20 minutes, and they must be paid as work time. On-call and waiting. Employees at times may be required to wait to begin or continue work. Depending on the circumstance, the waiting time may be considered work time. According to FLSA, employees do not have to be engaged in productive work to be considered working. If an employer restricts an employee's behavior and does not permit any personal business or activities to be conducted while waiting to begin work, the employee is considered to be engaged to be waiting. These hours would be included in the employee's time worked and then figuring overtime hours. However, the law does not require you to include the time spent on call If the employee is not physically at the employer's premises, but is merely asked to stay by the phone and is allowed to conduct personal business. In this situation, the employee is waiting to be engaged, in contrast to engaged to be waiting, and time spent waiting to be engaged would not be included in calculating overtime pay. Meetings and trainings. Employers are required to compensate employees for the time spent at seminars, meetings, or other required events. This may include travel time getting to the meeting. However, employees do not have to compensate employees for attending meetings when all of the following 4 conditions apply. Attendance is outside the employee's normal working hours. Attendance is voluntary. The event is not directly job related, and the employee performs no productive work during this period. Again, all 4 of those have to be met before they cannot be paid. Be aware that the rules about compensating for travel time to meetings, seminars are complex. For example, you must compensate if the employee travels during normal working hours, but you do not have to compensate for travel time outside of normal business hours. Again, this is federal law. States have different laws, as we well know here in Colorado. So remedial education exemption, an employer may employ a worker for a period of 10 hours in any work week in excess of 40 hours during the work week without having to pay the overtime premium if during that time the worker is involved in an employer-supported remedial education program. This program cannot include job-specific training. Rather, its purpose must be to provide individuals who lack a high school diploma or an 8th grade education with reading and other basic skills. Travel time, the principles which apply in determining whether time spent traveling is compensable time depend on the kind of travel involved. So home to work, you don't get paid to drive to your job. An employee who travels to work from home before the regular workday and returns to his or her home at the end of the workday is engaged in ordinary home to work travel, and that's not considered work time. Home to work on a special one-day assignment in another city. An employee who regularly works at a fixed location in one city is given a special one-day assignment in another city and returns home the same day. The time spent in traveling to and returning from the other city is work time, except that the employer may deduct that time the employee would normally spend commuting to the regular work site. Travel, that is all in the day's work. Time spent by an employee in travel as part of his principal activity, such as travel from one job site to another job site during the workday, is work time and must be counted as hours worked. However, the Department of Labor has ruled that travel time and work time may be paid at different rates. So as we know, some employers like to change and pay their travel time at minimum wage. Travel away from home community. Travel that keeps an employee away from home overnight is travel away from home. Travel away from home is work time when it cuts across an employee's scheduled workday. The time is not only hours worked on regular working days during normal working hours, but also during corresponding hours on non-working days. Time spent in travel away from home outside of regular working hours as a passenger on an airplane, train, boat, bus, or automobile is not counted as time worked. Again, that's federal law. We have to be a little careful with our state laws and make sure we're in compliance. So the Portal to Portal Act of 1947 defines the beginning of a workday as the time on any particular workday when an employee commences his or her principal activities. The act defines the end of the workday as the time on any particular workday when an employee ceases to perform his or her principal activities. So changing clothes is one of those things that is whether or not that's work time. So an employee's activity of changing into and out of clothes or donning and doffing while at work at the beginning and end of a shift presents compensability challenges for the employer. If the activity of changing clothes is integral and indispensable to the employee's principal activity, the time spent at this time is compensable. If the activity is not considered integral and indispensable, the time is not compensable. So for example, I told you my husband's a firefighter. When he puts on his bunker gear to go fight a fire, that's paid time. It's integral. It has to be done before he can go fight a fire. All right, so other things in FLSA is child labor. FLSA says employers must meet specific requirements when employing minors under the age of 18. And the law's purpose is to protect the health and well-being of the child and ability of the child to receive an education. So minors under 14 years of age generally are forbidden from working other than on family farms. Minors 14 and 15 years of age are not allowed to work more than 3 hours per day or 18 hours per week while school is in session. During school sessions, the minor can only work between the hours of 7 a.m. and 7 p.m. When school is not in session, they may not work more than 8 hours per day or 40 hours per week, and only between the hours of 7 and 9. There are no restrictions on the number of hours that 16 and 17-year-olds may work. 14 and 50-year-olds may not work in hazardous jobs. Minors under 16 years of age can perform certain work in retail, food service, and gasoline service establishments, but may not work in a job defined by the U.S. Department's Labor Wage and Hour Division as hazardous, manufacturing, or mining. Actors or performers and newspaper carriers under the age of 14 are exempt from child labor restrictions. Again, minors are not allowed to work in hazardous jobs, and there's big fines that go with that if you are making a minor work in a hazardous job. There are also many states that have more strict laws when it comes to child labor than the FLSA. FMLA, as we all know it, FMLA is the Family and Medical Leave Act, and it guarantees eligible employees unpaid leave for the birth or adoption of children and for serious medical conditions of family or family members or themselves. Closely related to this act and the benefit it provides to employees are the sick and disability policies most mid-size and large employers provide. There's also several states now that have paid versions of family and medical leave, and Colorado is about to join those. So FMLA guarantees eligible employees 12 weeks of unpaid leave within a 12-month period to care for a newborn or adopted child, a child, spouse, or parent with a serious health condition, themselves, if they have a serious health condition, or the employee's spouse, son, or daughter, or parent who is covered military member on active duty or has been notified of an impending call or order to active duty. FMLA is only required for public and private employers with 50 or more employees, including part-timers and employees on leave or suspension, but not laid off employees. An employee at a facility with less than 50 employees may still be eligible for leave benefits if the employees has at least 50 employees working within a 75-mile radius of the facility. To be eligible for FMLA, you must have been employed with the employer for at least 12 months and have worked at least 1,250 hours within the previous 12-month period. Exempt employees who have worked for the employer for at least a year are deemed to have met the 1,250 hours requirement unless they can prove otherwise. The law also guarantees that continuation of health benefits has to continue while they're on the leave. The Walsh-Healy Public Contracts Act governs the wages and hours of employees of manufacturers and dealers furnishing with federal government with materials, supplies, and equipment under contracts exceeding $10,000. Covered employees are paid 1.5 times their basic hourly rate for all hours physically worked over 40 in a work week. And the Wage and Hour Division has broad powers to investigate alleged violations of the act. The Davis-Bacon Act, under the Secretary of Labor, sets prevailing minimum wage standards for laborers and mechanics working on federally financed contracts, construction contracts of $2,000 or more. Overtime due covered employees is determined by the regular rate which is the hourly rate plus the fringe benefits. And we all know those as certified payrolls, which is always fun. The Contract Work Hours and Safety Standards Act requires contractors with the federal government, those that are not already covered by the Walsh, Healy, or Davis-Bacon, to pay employees at least overtime of at least 1.5 times their basic rate for hours worked over 40 in a work week. And the McNamara-O'Hara Service Contract Act applies to employers that contract with the federal government to provide services to a federal agency. Employers paid prevailing minimum wage and fringe benefits. So these are all public contract acts. And I will tell you that when I took my CPP, I did have a question on these, which kind of surprised me a little bit. So some of the employment forms, and you guys know about these, I'm sure. The Form I-9 is the employment eligibility verification form. It's proof that employees can work in the United States. Section 1 must be completed by the employee by the first day of work. Section 2 must be completed by the employee by the 3rd day of employment. They must be retained for 3 years from the date of hire or 1 year from the date of termination date. Documents that prove identity and/or work authorization must be reviewed by the employer. So those documents are those documents listed on the 2nd page of the I-9. Failure to comply comes with big penalties, anywhere from $573 to $4,586 for your first offense, and it goes up from there significantly. You can keep Forms I-9 as electronic records. Our payroll software does this. You can also use, and it's encouraged that you use E-Verify to verify employees' names and social security numbers. If an employee has lost their social security card, they would use Form SS5 to request a replacement social security card. Forms W-4, we've already talked about those. They are the employee's withholding certificate for federal requirements. All employees should complete a Form W-4, and they can also provide that information electronically when they're first hired. If an employee fails to furnish a Form W-4, new employees will be treated as if they had checked the filing status for single or married filing separately and made no entries in the steps 2, 3, or 4 on the 2020 form. If they were hired before January 1st, 2020, then they should be treated as claiming 0 and single. So employees can do a new Form W-4 if the circumstances allow them to either increase or reduce their withholding for several reasons. Many of those are listed here: death of a spouse. Employers should notify employees by December 1st if they need to file an amended W-4, if their filing statuses have changed. Employees cannot submit a revised Form W-4 before a change actually occurs. For example, if an employee is going to get married, they can't change their filing status until after the wedding. After an employee files an amended Form W-4, you must reflect the change in withholding no later than the first payroll period ending on or after the 30th day after you received the amended W-4. If you receive an invalid Form W-4, then you are to reject the form and tell the employee that they must redo the form. It's invalid if the employee indicates in any way that it is false. So if an employee tells you something that makes you think that what they put on their W-4 is incorrect, then technically that W-4 is invalid. And same as what if they do not furnish one, you're going to withhold at single or married filing separately and no entries in steps 2, 3, or 4. Employees may claim to be exempt if they had no taxes due last year and none are expected to be due this year. More exemptions. I'm running out of time, so I'm gonna let you guys read some of this. If you get a lock-in letter, you do have to comply with that lock-in letter. They do give time to the employee to contest the lock-in letter if they wish. So as an employer, you need to make sure that you have a W-4, you need to make sure that it's complete, and you are not required to submit to the IRS unless it's specifically requested. Keep all forms W-4 on file for at least 4 years from the last tax return filed using the information on the form W-4. W-4P is for distributions from qualified pension plans, and form W-4S is for distributions from a third-party sick pay. And that's all I have for you. Manon is going to send the PowerPoint and the glossary tomorrow. I think Manon, is that okay tomorrow?
Yeah, I'll send out the PowerPoint tomorrow and the glossary tomorrow.
Okay.
Next week, I will send out the PowerPoint and the glossary before class.
Okay. That sounds good.
Great job. That was so much material in 2 hours. I was exhausted.
Thanks, Melissa.
Wow.
Yeah, I can hear it. So next week or in 2 weeks, we'll have a different plan with a little more prep.
Okay, sounds good.
Thanks.
All right, thank you guys.
Have a good night.
Thank
Bye.
you.
Bye.
Bye.